Proper preparation for your business tax filings helps you avoid penalties for non-compliance and can lower your tax liability. Getting ahead of the game can save you time, money, and a lot of headaches. Whether you're a seasoned entrepreneur or just starting out, understanding this process is crucial to managing your business effectively and ensuring you meet all your legal obligations. Let's get started with the basics. Income tax is when you report your income, both earned and unearned, to the federal and state governments. Focusing on income tax is crucial because it directly affects your bottom line and requires careful planning and documentation throughout the year. Income taxes are different than deductions. Deductions are certain expenses that can be subtracted from your income before your tax is calculated. They can include things like office supplies, travel expenses, and insurance. Credits, on the other hand, are amounts that can be directly subtracted from the income tax you owe. They are typically awarded for specific activities like investing in renewable energy. It's also essential to understand the tax year, which for most businesses align with the calendar year, ending on December 31st. Key deadlines throughout the year include quarterly estimated tax payments and the annual tax filing deadline. These dates are critical to manage because failing to make these filings can result in penalties and interest charges. Now that we've covered the basics, let's get into the step-by-step guide on how to actually prepare for your business tax filings. Keeping meticulous financial records ensure you're ready for tax season, financial reviews, or audits. To manage your financial records effectively, consistently categorize and store receipts, invoices, payroll records, and bank statements. An often overlooked but critical aspect of financial organization is using a separate bank account for your business. Mixing personal and business finances can lead to significant complications, from tax errors to issues with legal liability. It clearly delineates your business expenditures, making it easier to monitor business performance and prepare financial statements. Additionally, incorporating a robust accounting system can greatly simplify managing all of these business transactions. It automates much of the record-keeping processes, minimizes errors, and provides real-time financial insights. For a much deeper understanding of the importance of an accounting system, check out our other video on this topic. It provides detailed guidance on selecting systems that enhance your financial management processes. Every business operates under a specific legal structure, and it's crucial to understand yours as it significantly affects your tax responsibilities. Whether you're just starting out or thinking about restructuring, knowing the difference can help you make informed decisions. Let's start with the sole proprietorship. This is the simplest form of business structure where there is no legal distinction between the owner and the business. If you operate alone, this might be your setup. Tax-wise, you'll report your business income and expenses on your personal tax return using a Schedule C, which is attached to Form 1040. The simplicity of this structure makes it appealing for many freelancers and independent contractors, but it also means you're personally liable for all debts and legal actions. Next, we have partnerships, which involve 2 or more people who agree to share in the profits and losses of a business. Partnerships themselves don't pay income taxes. Instead, income, losses, deductions, and credits are passed through to partners to be reported on their personal tax returns. Each partner files a Schedule K1 form, which shows their share of the partnership income. Partnerships must also file Form 1065, which is an informational return, to report their annual operating results to the IRS. Corporations are more complex and are considered separate legal entities from their owners, providing the benefit of limited liability. This structure can be taxed as either a C corporation or an S corporation. C corporations are taxed separately from their owners and must file Form 1120, the corporate tax return. S corporations allow profits and some losses to be passed directly to owners' personal income without ever being subject to corporate tax rates, using Form 1120S. Deciding between a C or S corporation affects how you plan your taxes and manage your company's income. C corporations are taxed as separate entities under corporate tax rates, resulting in a possibility of double taxation, first on the corporate income and then on the dividends paid to shareholders. So when does an S corporation really make sense? Number one, if the company's profits and therefore the owner's income push the owner into a higher individual tax bracket. The S corporation structure can help mitigate this by allowing the company to pay the owners in salaries and dividends, which may be taxed at a lower rate. Salaries are subject to employment tax, but dividends are not. The key benefit is the avoidance of payroll taxes on these dividends. Dividends are still taxed, but only at the owner's income tax rate. An S corp allows business owners to balance between how much to pay themselves via salaries and how much to pay dividends to optimize their personal tax liabilities based on their total income and current tax brackets. This is why it's important to understand your tax bracket and work with a professional to perform scenario analyses to determine the best strategy. To qualify as an S corporation, the entity must meet specific requirements. Make sure to reach out to a tax professional for a list of these. You might be wondering, where does an LLC fit into this? A limited liability company, or LLC, is a flexible business entity that combines elements of both corporation and partnership structures. Unlike corporations, which are subject to the corporate tax rules I've outlined, an LLC provides its owners, known as members, with a choice in how they are taxed. This makes it a very adaptable option for many business owners. The first way an LLC can be taxed is as a disregarded entity. A single member LLC can be treated as a disregarded entity, meaning it's taxed similarly to a sole proprietorship. The member reports the LLC's income and expenses on their personal tax return. The second is as a partnership. Multi-member LLCs are usually taxed as partnerships by default. Like traditional partnerships, the income, losses, deductions, and credits are passed through to the members to be reported on their personal tax return. And the third is as a corporation. LLCs can then choose to be taxed as either a C corporation or an S corporation. The primary advantage of doing business inside of an LLC is legal protection for its members. This protection means that members are typically not personally responsible for business debts and liabilities. Furthermore, the flexibility in tax status allows LLC members to strategically choose the best tax setup for their specific situation, minimizing their overall tax liabilities. An LLC is particularly appealing for small to medium-sized business owners who seek simplicity alongside the protection of limited liability. Unlike corporations, LLCs do not require a board of directors, shareholder meetings, or other formalities that corporations are typically obligated to perform. This can make an LLC easier and less costly to operate. The requirements for keeping up with corporate formalities are significantly reduced, which is ideal for owners who want to focus more on running their business than on administrative compliance. While LLCs offer many advantages, there are circumstances under which a business might consider transitioning to a different structure. Stay tuned for a future video on this topic. As we've discussed, choosing the right business structure is foundational to your tax strategy. Once you've established that foundation, the next step is to effectively manage your tax obligations. Accurately estimating your taxes can seem daunting, but fortunately, there are tools to simplify this process. One of the most straightforward methods is to use modern accounting software. These platforms are not only useful for everyday financial management, but also feature built-in tools to estimate taxes based on real-time data from your income and expenses. Additionally, the IRS provides resources that can be valuable in calculating your estimated taxes. The Form 1040-ES, for instance, includes a worksheet that helps you estimate how much you should pay each quarter. For those who prefer a more hands-on approach or have complex tax situations, consulting with a tax professional can provide tailored guidance. Tax professionals use sophisticated software and draw on extensive knowledge of tax legislation to provide precise estimates and strategic tax planning advice. Knowing how to estimate your taxes is crucial, but equally important is understanding how to effectively reduce your tax bill. Let's explore some of the most common deductions and tax credits that can significantly do this. One popular deduction for many small business owners is the home office deduction. If you use part of your home regularly and exclusively for business activities, you can deduct expenses like your rent, mortgage, utilities, and maintenance costs. Another key area of deductions is travel. When you travel for business, costs like flights, hotels, car rentals, and even meals can be deductible. However, it's important to keep detailed records to prove these expenses are business related. Also, consider equipment deductions. Purchasing equipment necessary for your business, from computers to machinery, not only supports your operations, but can also provide tax benefits. Under Section 179, you can deduct a portion of the purchase price of such equipment in the year it's purchased, rather than depreciating it over several years. Moving on to tax credits, which directly reduce your tax bill, dollar for dollar. Unlike deductions, which lower the taxable income, credits reduce the tax itself. These credits are valuable because they provide a direct reduction in your total tax due, rather than just reducing the amount of income that's taxed. One notable credit is the Small Business Healthcare Tax Credit. This is designed for small businesses that provide healthcare benefits to their employees. Another valuable credit is the Research and Development Tax Credit. This credit is aimed at businesses involved in developing new products, processes, or software, essentially rewarding companies that invest in innovation. Finally, the Energy Efficient Commercial Buildings Tax Deduction, relevant to those who have made energy efficient improvements to their building properties. This includes upgrades to heating and cooling systems, lighting, and the building envelope. These tax credits represent just a few ways you can directly reduce your tax liability. The only way to take advantage of these tax strategies is to start your tax preparation early and possibly engage with a professional who can ensure that your filing is accurate and maximizes your benefits. If you are feeling unsure about any part of the tax preparation process, or if you just want to ensure that everything is handled perfectly, professional help from our specialists at DeMar Consulting Group are a resource for you. We're ready to help you optimize your tax strategies, ensure compliance, and reduce your tax liabilities. Just click the link below to schedule your consultation with us today.